Hi, Mike Almala, Recovering CPA, back at you for Lesson 2. In this lesson, I'll explain why financial accounting is not a precise science. The aim of financial accounting is to provide useful and reliable information about businesses. Financial accounting seeks to determine a firm's economic performance and its condition. Did it make a profit or loss last year? What assets and liabilities did the business have at the end of the year? The answers to these questions are summarized in two basic statements: the income statement and the balance sheet. I'll be going into greater detail about these statements in later lessons. Determining a firm's economic performance and condition often is very difficult. Unfortunately, financial statements rarely are able to give completely definitive and precise answers to what seem to be simple, straightforward economic questions. Why would this be so? Four factors underlie accounting's measurement problems. First, it is difficult to pin down exact criteria for measuring economic performance. Second, it is often difficult to assign values to assets. Third, accounting uses money as its fundamental measurement unit, and money's unit value is not stable over time or between currencies. Fourth, accounting rule makers have to compensate for the fact that business managers and owners often are motivated to distort economic reality rather than reflect it accurately. In terms of economic performance, our simplest criteria for doing well surely involves looking at cash flows. A business does well if it brings in more cash than it spends, and vice versa. But for all but the very simplest of businesses, such a measurement approach can be very problematic. Negative cash flow is not necessarily equivalent to poor economic performance, and vice versa. Accounting encounters even more difficulty in trying to pin down a firm's economic condition. To determine economic condition, we want to find out about a firm's assets and their values. But there is more than one standard of value. Should accountants use current market values for assets owned or the original cost incurred to acquire them? Rarely are these two values the same, and that there are advantages and disadvantages to both standards. There is also a legitimate controversy about what should be counted as assets on the balance sheet. For example, should the value of personnel or intangible assets such as patents, trademarks, and goodwill be measured and included? If so, how do we measure their value? In accounting, the unit of measurement is money. Money is a medium of exchange that has value only to the extent that it can be traded for goods and services. But money is not a stable unit of measurement because exchange values varies with time. What $1 buys today in goods and services is almost never the same as what that same dollar purchased last year or will purchase 2 years from now. Practical ramifications of this instability of money as a measuring unit are pervasive. If a company had net income last year of $100,000, was its economic performance the same as it was 5 years ago when its income statement also showed $100,000 net income? Decidedly not if the purchasing power of the dollar changed significantly in the intervening 5 years. Questions about economic condition are also affected by the instability of money as a measurement unit. For example, consider two companies, each with $500,000 of liabilities. In the case of one company, all its debt must be repaid within 1 year, while the other company's debt does not have to be repaid for 10 years. Are the economic conditions of the companies the same? Again, decidedly not, because the purchasing power of the dollar will change over the next 10 years. Accounting rulemakers have struggled greatly with the question of how and when these changes in the value of money should be reflected. Now, measurement error is unavoidable. But it would be nice if we could assume that almost everyone involved in the accounting measurement process was highly motivated to avoid errors. Sadly, this is not the case because business managers and owners often wish to avoid accurate measurement if such accuracy would lead to significant damage to their career and finances. Facing such ruin, managers will be strongly tempted to avoid fair and accurate measurements. Managers and owners will seek to cook the books. There are two important ramifications for accounting stemming from this motivational bias. First, in order for financial reports to have any credibility at all, they have to be verified by independent auditors. This is an expensive and often imperfect process. Second, in formulating accounting rules, the rulemakers have to carefully consider how any proposed measurement procedures might be subverted by managers intent on providing a skewed view of economic performance or condition. The practical consequence is that the accounting rules that might be most logical and simple are often not adopted because these same rules also tend to be the easiest ones for managers to distort. As you go through this course, I will return to these challenges again and again. Click the next lesson on generally accepted accounting principles.